Definitely a number of headlines that investors and traders are having to consider this week. That is for sure. We, of course, also have the S&P 500, those U.S. markets in the longest bull market ever in history. Our next guest, however, says don't overlook the Canadian market. He believes that there are some major upside potentials in Canadian stocks. Joining us now in studio is Parets, technical analyst and founder of allstarcharts.com. Nice to have you in studio.
Thanks for having me.
You are here tonight speaking at the Canadian Technical Institute, correct?
The Canadian Society of Technical Analysts has invited me, and we are speaking at the, I will be speaking at the CFA Society, and the CMT Association in America is co-hosting it with the Canadian Society, so it should be a lot of fun.
Great, and it's nice to have you in studio. That's always a bit of a bonus.
Happy to be here.
Let's talk a little bit first about your market outlook for those U.S. markets, given the fact that they are in the longest bull run that we've seen.
Well, you know, we've actually been in the camp that we're not in the longest bull run. You know, the main, and you and I have talked about it before, you know, consensus right now is we're in the latter stages, longest bull market ever. And the beauty of that is I think that couldn't be further from the truth. In fact, I would argue that we're only in the second year of a bull market, or just entering the third year of a bull market that began in summer of 2016. So part of that sentiment, that consensus that we are in the late cycle, I think is part of the fuel that will continue to drive this rally substantially higher.
JC, just explain to us, though, why you think we're in the second inning and not the last inning. Well, from a technical perspective,
sure,
because people would find this very hard to believe.
Yeah, you know, people like to cherry pick 2009 because that was the low, right? So that if that was the low, then that means that we're 9 years in or whatever it is. But then we always talk about the bull market starting in 1982. We don't talk about the low in 1974. Right? So why are we now changing the way that we look at bull markets? So that's number one. Number two, from 2011 to 2016, emerging markets got decimated, right? Energy stocks got destroyed. Small caps, biotech stocks, absolutely destroyed throughout 2015 into early 2016. So to suggest that that wasn't a bear market just because the S&P only fell 19% instead of 20, that magic 20 number, and we also had a similar correction in 2011. So I think we've had multiple resets since 2009, to the point where I believe that the beginning was when interest rates bottomed in the summer of 2016, as well as European banks. Once those bottomed and the market really started rallying before the U.S. elections, I think that was the beginning. So I think we have a long way to go.
Okay, so specifically in the S&P 500, do you think that we do? And what about the NASDAQ and the Dow?
Yeah, well, remember, the correlations are through the roof between the Dow, the S&P 500, and the NASDAQ. They have different components, obviously, but overlay those charts going back decades, and they look exactly the same, pretty much. They go up and down together. Obviously to varying degrees. You know, in 99, the tech stocks dominated technology, so the NASDAQ did outperform in the late 90s, for example, but when you kind of smooth it all out, they really move in sync. So if we think the S&P 500 is going higher, the Dow Industrial should follow, the transport should follow, S&Ps, you know, Russell 3000, all of them should move in sync, and I think Canadian equities will rally along with the U.S.
So let's take a look at the TSX as well. You are recommending that investors buy it. I mean, where do you see it going? It's only up 1% year to date. It hasn't done a lot for a number of years. It's disappointed a lot of investors.
Catherine, we're flat for a decade.
Right.
We've done nothing. So to me, that pent-up demand, that frustration that you speak of, I think that's great. I think it's a huge bullish catalyst. You know, we ran up and rallied into, 2008, and a lot of stocks fell apart after that. So the fact that Canadian equities are just now breaking out of that base, to me, the way I learned it is the bigger the base, the higher in space, and there's plenty of consolidation to drive it higher. So 16,000, I think there's solid support there. As long as we're above that 16,000 level, I think we have to be bullish. I think we go to 20,000. I think we have 25% to the upside.
In what time frame? Not to pin you down so much. I mean, the fact that you're saying it's going up and higher and stronger, might be enough. But what's your time frame here in terms of getting the catalyst and really getting some momentum behind this market?
Yeah, I think it's happening now. Obviously we're not going to rally 25% overnight. Markets don't work that way. But I think in the coming quarters, the next 3-4 quarters, we need to err on the long side. We don't want to be selling strength. We want to be finding stocks to buy on weakness. And when you see a sector like financials really breaking out and driving this market higher, Bank of Montreal, things like that, those are the sectors where we want to see leadership, right? Not weakness, right? We want to see the banks and stuff lead, and that's exactly what we're seeing.
So let's take a look then at the banks and where you're actually seeing this leadership occur, because I think that some might also be disappointed about the reaction to the latest earnings. I think people would have thought that last quarter, maybe this quarter as well, we're just getting going, we would have seen greater momentum. So we're taking a look at Bank of Montreal right now. What are you seeing from a technical perspective?
Speaking of basis, you're looking at this 104 area that's been overhead supply for a year and a half, and we are just now coming out of that. So as long as we're above that 100, 104 level, I think we need to be long, right? Because, Catherine, that former ceiling, that overhead supply, once we break through that level, that's the market suggesting to us that the demand has finally been able to overwhelm that overhead supply, and now we can move forward. So as long as we're above those former highs for the last 18 months, I think we have to be long.
So we're looking at Bank of Montreal. Is that your top pick within the financials, or can we broadly own the financials on the TSX?
I like the sector for sure. Okay. I like the sector overall in both the U.S. and in Canada. I like them both. And technology, we talk about, what's going to drive this market higher. These technology stocks, particularly in America, represent 25% of the entire S&P 500. And Catherine, we are just now breaking out above those 2000 highs. So when we talk about Canada doing nothing for a decade, U.S. tech has done nothing for 2 decades. So you want to talk about, we're in the latter stages.
Feels like it's done more. It's pretty amazing.
We're just getting going.
All right. Let's take a look at a few more Canadian names that I know you like as well. CP Rail's another one.
Oh, I love them. So Canadian Pacific, railroads in general, this has been part of the bullish thesis overall. If you have the Dow Jones Railroad Index, breaking out of 6-month basis to new all-time highs, how can you possibly be bearish equities overall? So Canadian Pacific here in Canada, I like 147. I think there's good support there. I think we can go to 313. To me, 247, excuse me. Those were the former highs 3 years ago. Okay. So I think we have, another 50% of upside in Canadian Pacific and railroads in general, Catherine.
Okay. Let's continue with the picture here. Our telecoms, they were actually earlier today showing a little bit of strength in a down market here in Canada. What do you like in the telecoms in the Canadian space?
I like Rogers. I really do a lot. 69,
Still, even though we've got this nice performance.
Well, it's a stair-step higher, right? And we've had nice performance, but we're only back to former overhead supply. So we want to buy this breakout above 69. I think we can go to $95. I think that's a lot of upside. We're not here to be right. We're here to make money, right? So we want to identify asymmetric risk versus reward opportunities, and I think this is one of them. The risk is $69. We only want to be long if we're above that. If we're not, then it's somebody else's problem.
Okay.
Right?
So that's one to watch pretty closely then. Yeah. Make sure you know where that number is. So 69 on Rogers.
69
if we can't
on
break
RCI.
above that, okay, then we've got some potential downside.
Agreed.
What else are you watching these days?
Within technology, I think we have to identify the strength in semiconductors, right? And getting back to doing nothing, just like technology has done nothing in America for 2 decades since the peak in 2000, semis look exactly the same. They also have done nothing. We are now back to those former highs. So we're in the camp that we are not only seeing a new secular breakout in technology, but also in semiconductors. And you can't talk about semiconductors without bringing up NVIDIA. That's the big leader there. 245 is the level we're looking for. I think we can go to $400. I think we have a tremendous amount of upside in NVIDIA and semis in general.
How do you get 400?
So the way we analyze it, we go back to the past and, we calculate the 161.8, 261.8% extensions. This is all Fibonacci math, right? So we see it all throughout the universe. I don't want to dive into nerdy math, but you guys out there who are into the stuff really appreciate it. We see it in natural patterns. We see it in our own human bodies. I mean, it really is a natural phenomenon. And then if you look at NVIDIA, go back to the beginning, mark up those Fibonacci extensions. It literally kisses it, reverses, breaks out, kisses the next one, reverses, breaks out. And it's literally a stair-step higher. We're seeing the exact same thing throughout 2018. So there's no evidence to suggest that pattern has changed. To the contrary.
It's interesting when you talk about tech having done nothing for a decade, and we're showing the picture going back to 2009, and NVIDIA had been flat for 10 years, essentially. But many investors or viewers might say, well, what's he talking about? Because Apple's done well, Amazon's done well, Google's done well. So when you're talking about tech, you're speaking of the broad tech sector.
Oh, yeah.
Not these other stocks that have really
Right.
been leading the market higher.
And then listen, and people think that that's weak breath, the fact that the Googles and the Apples are leading it higher. But, as they say, the best players are supposed to score all the points, right? LeBron James should be scoring all the points. Kevin, they're the best players on the team. So there's nothing wrong with that. And we've looked back throughout history and see if the fact that the biggest market cap stocks are leading, is that a bad thing? And we've never seen evidence that it is. But when we talk about broad tech, it's not just the biggest and the baddest, right? The little guys are coming through too. We're seeing breakouts to all-time highs in the Russell 2000 small caps, the mid-cap 400 that, people forget about the Jan Brady's of the world, the mid-caps also breaking out. I just think we're seeing an overwhelming amount of strength and broadening participation, which I think is solid.